Uh, Great. Thanks everyone so much for coming to the virtual seminar on climate economics. I'm Ishan Nath, an assistant professor at the Harvard Kennedy School. And the Center on Economic Policy Research, through its climate change and environment program, has provided key support for this seminar. And my co-organizers are Mar Requant from Northwestern, Fran Moore from UC Davis, Lint Barrage from ETH Zurich, and Glenn Rudebish from the Brookings Institution. The virtual seminar on climate economics covers a wide range of topics in the economics of climate change, all the way from macroeconomics and microeconomics to finance, which we'll learn about today, econometrics, international, and energy economics. Our speaker today is Johannes Ströbel, who's the David Loeb Professor of Finance at New York University Stern School of Business. Professor Ströbel was in 2023 awarded the Fisher Black Prize by the American Finance Association for the top financial economist under the age of 40. He has a lot of exciting work, and of course at this seminar we're most excited about all of his work on climate finance. And today's talk is going to be titled Carbon Price Uncertainty and Decarbonization Investments. And the way this seminar is formatted, there will be a 50-minute presentation with short interruptions only for quick clarifying questions. And then at the end, we'll have a 25-minute question and answer session. So with that, we'll let Professor Ströbel take it away.
Perfect. Thank you so much, Ishan, and thanks to the whole organizing committee for putting, this talk, but also the series together. I think we need as much research in this space as we can possibly produce, and also it's a great way to for the community to get together. So thanks also everyone for listening. As Ishan mentioned, this paper is looking at the effects of carbon price uncertainty on firms' decarbonization investments, and it's co-authored with Max Fuchs at Copenhagen Business School and Julian Terstege at the University of Michigan. The motivation for the paper is relatively straightforward. We all know that a key global policy objective is to reduce carbon emissions, and a very common tool to achieve this objective is through cap and trade systems, right? So cap and trade systems, which now cover, which is more like 22% in the latest estimates, cover about just under a quarter of all global emissions. They work in a relatively straightforward way. So a regulator will decide on the overall emissions that it wants a certain economy to have, and then it will issue a certain number of emissions permits, and every company or every covered entity that wants to emit a ton of carbon needs to surrender one of these certificates at the end of the year. But what's important is that firms will then subsequently trade these permits among each other. That has many benefits in terms of efficiency. It ensures that the emissions reductions are done by the firms that have the lowest cost of reducing their emissions. So it ensures that overall you have, you can achieve sort of the aggregate emissions reduction that the regulator wants to achieve in the most efficient way. But in the process of trading these permits amongst each other, there's going to be a market price, right? And that equilibrium price will be driven by the interaction of supply and demand, as in all markets. So permit supply will come largely set by the regulators. So the regulator decides how many permits there are, and that's something that can change over time. And in many of the cap and trade markets we have around the world, we have seen that regulators, sometimes in an ad hoc way, adjust the number of permits in there. But the equilibrium price will also be driven by permit demand, right? So how many permits firms want to buy at any given point in time, and that's driven by a whole range of variables. Important one is just general economic activity, right? So as you go into a recession, there's less economic output, firms produce less, they need fewer permits, and so permit demand falls. But also it's driven by things like, the abatement cost of technological advances. If it becomes cheaper to reduce your carbon emissions at a low cost, you're going to demand fewer certificates and rather try and invest in decarbonization as it's become cheaper, and that's also going to affect permit demand. So you can see that both permit supply and permit demand move around. And that introduces an uncertainty about future carbon prices, right? And this is very different to, say, a carbon tax, where the regulator says up front, we're going to be, charging you $30 per ton of carbon. In the case of a cap and trade system, the regulator achieves certainty on the total emissions reduction. But from the perspective of a firm, they don't know whether next year a ton of carbon will cost them $10 to emit, or $30 to emit, or $40 to emit. And that uncertainty and the economic effects of that uncertainty are going to be at the core of the paper that I want to talk about today. We have much theory in economics about how uncertainty about a variety of variables affects how firms behave. And the theory here is very similar. So the idea is that when you have uncertainty, it might delay partially irreversible investment decisions. So if you're a CEO and someone comes to you and says, look, we have this great new technology and it'll cost us $50, to reduce our carbon emissions by 1 ton. If you're a CEO and you know that next period you'll pay $60 per ton of carbon emissions, this is a great investment and you'll go. But if you're uncertain whether or not you'll pay $50 or $40 or $80, right? You might say, well, let's wait a little bit to see what carbon prices are next period before we make this irreversible, expensive investment. Because if it turns out that carbon prices next period are low, I'd much rather buy a certificate in the market rather than kind of spend to reduce my emissions, right? And so, applied to an emissions trading scheme or an emissions trading system or any cap and trade scheme, polluters in some sense have a real option to invest in decarbonization. And, as carbon price uncertainty goes up, that will increase the value of this real option. And in some sense, it raises the net present value of waiting to make the decision relative to the net present value of exercising the decision. And therefore, our theory should tell us that carbon price uncertainty should lead to a delay in the decision to invest in decarbonization. And again, the old theoretical models behind this have been around for many decades, Dixit and Pindyke, Bernanke, and so on. There's been sort of variety of iterations of this. Nick Bloom has had sort of a wave of really cool research about how uncertainty affects, the delay of decision making. It raises the inaction bounds, etc. So conceptually, there's nothing new here. But I think in the space of carbon markets, I don't think we've studied before, quantitatively how big this carbon price uncertainty is and whether or not, it does have quantitatively meaningful effects on, how firms actually choose their decarbonization. Here's maybe just 3 anecdotes that suggest that this type of carbon price uncertainty does matter for firms' decisions to decarbonize. So the first one is from a report in Canada, studying the Canadian cap and trade system. And, it's a large scale report. And they reported, look, that, anyone from industry to commercial investors and other stakeholders state that carbon price uncertainty is inhibiting investment. Maybe just go to the last one. Many of you are based in Europe. This is from 16 UK large European utilities companies who wrote that we want a carbon price floor because what it would do, it would reduce volatility and uncertainty for investors and therefore increase the speed of the urgently needed transformation to low carbon energy systems. Right. So their idea was we can't build out renewables if we don't know what the carbon price is going to be, because only if the carbon price is high enough our renewable investments going to pay off or not. So they're actually going out and saying, put a lower bound on the carbon price, right? So we can be sure that any investment that reduces carbon emissions at a cost less than that lower price will pay off with certainty, rather than sort of having us wait and just sit around to figure out what the carbon price is going to be down the road, right? So this seems to be something that, at least anecdotally people care about. And so what we do in this paper is to try and ask the question, does carbon price uncertainty inhibit investment? And more importantly, is this effect quantitatively important, right? Is this sort of a meaningful, deterrent to firms' decisions to invest in decarbonization today? So the paper will have 3 parts. So what we're going to do in the paper is we're going to, and I think this kind of, I think this maybe the most novel aspect of the paper is to actually produce a high frequency measure of carbon price uncertainty that we call the carbon VIX, which is based, on options prices in the EU emissions trading system. We have a website where we release that data if this is something that you're interested in working with as well. And I'll walk you through how we go from option prices to backing out uncertainty. But this is something that's very commonly done in finance, and I'll walk you through what we do there. We're going to use that to document the properties of carbon price uncertainty. How much uncertainty do investors have today about what the price of carbon is a year from now? And then in the last bit is we're going to test the real effects of carbon price uncertainty. We'll try to use this new measure of high frequency of carbon price uncertainty to try and figure out, to what extent it actually does inhibit decarbonization. What do we find just at a high level? The first thing is carbon price uncertainty is extremely high, right? So the average carbon VIX is about 54. I'll give you a sense in a bit when I tell you exactly how we construct it. For those of you who have not worked with VIX numbers before, what this means. But this kind of tells you that the average expected volatility of carbon prices over the next year is 54%. Right, so this is a huge amount of uncertainty. It varies substantially over time, with persistent shocks that make a lot of sense when you see where uncertainty goes up and when it doesn't. It's quite distinct from other uncertainty measures, right? So carbon price uncertainty is weakly correlated with things like general economic uncertainty or oil price uncertainty or a range of other metrics. There's obviously ways in which it links, right? If we said before, general economic uncertainty, given that economic activity is a driver of certificate demand, obviously economic uncertainty should lead to demand uncertainty and therefore price uncertainty. So we see that a little bit, but it really does seem to be a distinct dimension of uncertainty. And then lastly, and maybe most importantly from a policy perspective, we realize that we show that carbon price uncertainty substantially reduces decarbonization. That's really with the focus on substantially. So I'll have some comparisons for, if we reduce uncertainty by some amount, what's the equivalent increase in the average expected carbon price that would give you the similar effect on decarbonization? And it's pretty meaningful, right? So uncertainty has a really large effect, negative effect on firms' willingness to invest in decarbonization today. Just one last thing to kind of point out here that I think is worth highlighting early on. It's the question, well, if the cap is binding on aggregate, how does the decarbonization decision of an individual firm actually make a difference to the overall cap? And I think the important thing here to realize is that the cap is binding on aggregate, but not year by year. In fact, in most years, what ends up happening is that we don't emit as much as the cap and that we carry certificates over into future years to be used down the road, right? And so it is entirely possible for this sort of delay in decarbonization to actually raise aggregate emissions today, because aggregate emissions at the moment are much lower than the outstanding level of emission certificates there. So it's not like this cap is binding year by year. And in fact, by burning more certificates or retiring more certificates today, we're going to, through mechanisms like the market stability reserve in the ETS, which basically says if there's too many certificates in the system, we take some out, right? By actually retiring certificates today, we delay the taking out of certificates down the road. And so, I think that this delay in decarbonization at the individual firm level does aggregate up, I think, to certainly more emissions today, but also quite likely more emissions on aggregate. Right. Now, that's something that we can't test as cleanly as the firm level decisions, and I'll show you why. But I think there's lots of reasons to think that this, actually leads to more output and more output sooner in terms of carbon emissions than it would be if we reduce carbon price uncertainty, right? Okay, let's see if there's any questions at this point before we dive into the material here. Okay, great. So how do we measure carbon price uncertainty? So our setting is going to be the EU ETS. It's the world's oldest and largest cap and trade scheme, and it covers Scope 1 emissions of more than 10,000 installations across 27 EU member states. Much of the energy, manufacturing, aviation sector is covered. About 40% of all emissions in the EU. And it's a trading scheme that keeps growing, right? So the sectors that are covered by it keep getting expanded. In 2013, the European Union set a cap, and on annual EUAs, these are these emission certificates, and it also set a path for that cap. So every year, the total number of certificates that get sold gets declined by declines by about 2 to 4%. There's an extremely high compliance rate in this market. So basically, it means you really do need to have a certificate if you're going to pollute. And one central thing that I already mentioned is these EUAs can be rolled over, right? So a certificate you buy this year doesn't have to be used in this year. You can carry it into next year and into future years in anticipation, potentially, for example, of rising prices. There's 4 different markets where four different markets that are related to these certificates where it's trade. The first one is sort of the primary market. These are auctions that the EU runs, often several times a week, and a pre-announced schedule where just some of these certificates get auctioned off. Then there's a secondary market where these certificates just trade with each others. And then there's a futures market where you can basically trade on future certificates today. Now, what's really important is that the first three markets are basically the same, right? So, the price in the auction market basically is whatever the secondary market price for certificates is at any given point in time. And importantly, because you can carry these certificates into the futures price and today's spot price are linked basically just by the cost of funding of an investor, right? Because if the futures price was much higher than today's price, you could borrow money today, buy a certificate, sell the future, and basically have an arbitrage profit. So there's in some sense no arbitrage conditions between the spot price today and the future price that's linked by just the cost of funding of an arbitrageur, right? So the first three markets are relatively boring. And it just turns out that much of the liquidity ends up being in the futures market, at settlement dates that are close to when the EU asks you to actually physically deliver certificates for the emissions that you've had. But again, all three markets have prices that are very, very tightly linked through no arbitrage conditions, okay? The last market, and the one that's most central to our empirical analysis, is that there's also options that are trading on the futures, right? And we're going to use the prices of these options to back out uncertainty. And I'll talk a little bit more about that in just a slide or two. A little bit more just sort of summary on the market and the price and how it's developed for those of you who haven't followed this as closely. So this is prices in the, of these certificates over time. So when the market, so for much of the 2010s, the prices were extremely low, right? They were about 6, 7, 8 euros a ton. That's like orders of magnitude away from where like meaningful measures of a social cost of carbon sit. And I think it's in part because too many certificates were issued. And so in 2018, the EU decided to introduce this market stability reserve and other mechanisms like that to just reduce the number of certificates. And one thing that you can see is that subsequently prices went up. And then for much of the early 2020s, they were hovering about $80. I think right now it is about $75 or something like that. So it's a pretty meaningful price per ton of carbon emissions. I think it's one of the highest carbon prices anywhere in the world, okay? So it's a pretty meaningful cost at the moment. This gives you a sense on the options market, right? So this gives you, the total open interest and the total number of contracts. And one of the central thing to see is as prices went up, 2018 onwards, the options market also exploded in terms of activity. Why? Because, in some sense, uncertainty doesn't really matter to you when, prices are $6, because whether or not you pay $4 or $8 doesn't really affect the overall economics. But, when prices are $40 or $80 per ton of carbon, it suddenly affects the economics of your decision to pollute versus decarbonize quite dramatically. And so once, the average price went up and it became a much more meaningfully economic factor in the decision-making of firms, in those periods, you also start seeing firms wanting to buy options. One thing for those of you who've looked at options data before, one interesting thing is that many of the options, that there's pretty meaningful liquidity in the options, even options that are relatively what we call far out of the money. So let me explain what that is. So imagine, a call option. So how does a call option work? A call option basically is a contract that gives you the right, but not the obligation to buy a certain emission certificate at a pre-agreed upon price that we call the strike price, right? So it's a financial contract that gives me the right, but not the obligation to do that. And a deep out of the money call option would be one where, what if today's price is 50 and I have the right to buy it at 80, right? Now, in most likely scenarios, I don't want to exercise the option. Because if at option expiry date, the price in the market still is around 50, the right to buy it from someone at 80 is worthless. I will let the option expire. Again, the important thing is it's the right, but not the obligation. I can choose whether I want to do that. And so, I will rather buy the certificate in the market at 50 and let the right to expire at 80, decline. So that would be a far out of the money option. An option that would be more at the money is one where, current market price is 50 and I have the right to buy at 50, right? It could still be that the price goes down to 45, in which case I will still let the option expire. I'd rather buy at 45 than at 50. But as soon as the price goes up, it goes to 55. Suddenly this option becomes valuable and it would be in the money because now I have a piece of paper that says you can buy something that's worth 55 at 50 from me, right? And this kind of very simple simple logic is already core to the intuition of how you can back out uncertainty from option prices, because the one-sided nature of the bet basically tells you. So imagine you have an option and with a strike price at 50, and imagine the current market price is 50, right? Now imagine you have a low volatility environment or low uncertainty environment. So next period the price is either 45 or 55. Right? Well, if the price is 45, I'll let the option expire. And if the price is 55, the option is worth 5. So it's like with 50% probability, it's worth 0. And with 50% probability, it's worth 5. Right? Now imagine we had much more uncertainty. And next period could either be 40 or 60. Right? Now, again, if it's 40, the option is still worthless. Right? So sometimes as prices keep declining, the option doesn't get worth less than 0 because I can always just walk away from this. But as the option price keeps going up, I keep making money. Right? So you can see that as uncertainty goes up, the value of call option increases. And importantly, the very same logic is also true for the value of put options. Put options are the right to sell a given certificate to someone at a pre-agreed upon price. Now, if the market price goes higher than that pre-agreed upon price, the option is worthless and it's 0. If it goes lower, then it's valuable because I can buy the low thing and then sell it to someone at the price we agreed upon. Right? And so again, as uncertainty goes up, the value of put options goes up. And this is really one central feature of all option prices, is that both call and put option increase in value when uncertainty goes up. When expected prices move, one increases in value, the other decreases in value, right? Like a fixed right to buy something at a certain price, obviously is more attractive when the price goes up. And the fixed, the market price goes up, and the right to sell at a given price gets less attractive when the market price goes up. So directionally, price increases and price decreases have opposite effects on the value of put options. But just uncertainty around a given mean increases the value both of put options and of call options, right? And if you can follow that intuition, you'll be able to see why we can use the values of these options to back out how much uncertainty there is in a market at a given point in time. Because basically the idea is that when the value of both put and call options go up, that is going to be a scenario when there's a lot of uncertainty about future prices. And when the values of both puts and calls go down, that's going to be a scenario where we have less uncertainty, right? And so, I'll talk to you about how we exactly implement that intuition, but if you can kind of follow that intuition, I think you'll see much of why these option markets are really helpful to back out uncertainty. So again, the idea of the VIX is to, and so here's how you do it mechanically. What you do is you put together a portfolio of options that combines, both at the money and out of the money puts and calls. And the idea is to construct a portfolio that has a payoff that's going to mirror the ex-post realized volatility of the EUAs, right? The nice thing about this is something that people have worked out before us. So many of you have come across the VIX in general, which is a measure of the uncertainty in S&P 500 index options in the US, right? So people call it the fear gauge or the uncertainty index. Many people have used that one before. And so the CBOE, the trading platform in Chicago, has developed exactly how you combine these options to back out annualized uncertainty. So in some ways, we're just applying that technology and that insight to the options market on carbon futures. And again, the idea is that when expected volatility goes up, the price of this portfolio goes up. And so, so this is a really nice way to back out carbon price uncertainty at extremely high frequency, daily frequency, weekly frequency, whatever you want, in a way that that's actually model free. So this does this VIX idea, because you use far out of the money puts and calls. You don't actually need to use a pricing model. So it's a model-free way of backing out, and the only thing you need is a no arbitrage condition. You don't actually need a pricing model. What it does require is you need liquidity for the far out of the money options, right? Because if you don't have any liquidity there, the prices aren't that informative about uncertainty. And so that's why what I showed you before, that we do have meaningful liquidity across a range of what we call moneyness of the options, is really, really helpful for us to back out carbon price uncertainty. Okay, so here is how the resulting metric of carbon price uncertainty looks like. And what it tells you is that you have a return volatility of about 50 or 60% at an annualized frequency, which is extremely high. And I will show you, what it's just to give you an example. The VIX on the US stock market right now, so the implied annualized return volatility just on US stocks for the next year is about 18 at the moment. Right, so this is, this is like multiples in terms of the expected return volatility of EUA futures rather than carbon futures. I'll also show you the oil VIX, just about like oil price returns and how uncertain they are. This is by far the most volatile, asset in terms of, anticipated volatility. People have looked at this before. Realized return volatility is also extremely high in this market, right? So so these assets, these, can think of emission certificates as an asset. They have extremely high volatility in terms of realized volatility and also a lot of uncertainty. So what you can see is that carbon price uncertainty spikes around the types of events that you expect it to spike. So one of them, are sort of regulatory type events. So for example, the introduction of the market stability reserve. There was, this was like, when the EU was like, well, we're going to change how many certificates are available. Like at that point, the uncertainty about future prices goes up a lot, obviously, because you don't really know what they're going to decide. And so you thought they'd settled on some path of certificates that were going to be available. Now they say, well, we don't like the fact that prices are too low. We're going to change it. And so there's uncertainty there. But you also see things like COVID-19 or Ukraine war, energy crisis, or other macro type shocks to the economy also lead to carbon price uncertainty. Largely, those ones I would interpret largely through the lens of demand uncertainty, right? When COVID hits, you have no idea how long your factories are going to stay shut down. Well, if your factories are shut down, you don't need an emission certificate for your pollution because you're not polluting, you're not producing. And so when there's uncertainty in terms of general economic activity, you also see carbon prices to go high. One thing you see is that return uncertainty has always been high, right? So even in 2014, 2015, 2016, right, the return uncertainty was high, but because the level of the price was so low, a 20% return on a $6 investment is just, 6 versus 7 or 7.5, which doesn't really have meaningful effects on, the value of a certain decarbonization investment, the way that, do we do 50 or 70 per ton? And we're going to see that, and we're going to, in some sense, split our sample later into the effect of carbon price uncertainty on decarbonization during this early period when prices were essentially economically meaningless, and during the later period. And so you can think of the early period almost like a placebo period, a period where you wouldn't expect carbon price uncertainty to have a lot of effect on firms' decisions, just because carbon prices were so low that, firms were telling the regulator this. It's like at a carbon price of $5 or $6, it plays no role in my decision of whether to decarbonize and how to build this. And so obviously uncertainty about carbon prices also didn't play a role, while that was then motivated the regulator to raise prices, to reduce supply in order to raise prices, to get firms to actually care about this, right? And so we're going to have this earlier period, despite the fact that uncertainty was pretty high during that earlier period too, because the level was so low it didn't matter. Okay. This just gives you a sense of how high the VIX is. The uncertainty is, again, the dark line is for carbon, and then red is equities, and the dotted line is oil. And what you can see is that sort of the average level of where the carbon price uncertainty is in general was like peak equity uncertainty during the COVID crash. Right, just to give you a sense of like how much uncertainty there is. This is like if you put yourself in like February 2020 or whenever, when markets had gone down 20%, nobody knew if the world economy was ever going to recover. The amount of uncertainty about the stock market returns over the next year is roughly the amount of uncertainty that investors in carbon markets face at any given one point in time in terms of return, right? So this is a really, really, quantitatively meaningful bit of uncertainty. Again, kind of aligning with all of these investors saying it's really, really hard to make a decision on a renewable energy plant or something if you can't tell us whether or not prices next year are 30 or 60 or 70. Like it's just really, really hard to make any meaningful investment decisions in that environment. So what do? We don't make investment decisions. We'll wait and see and figure out if you can provide more certainty. Here is just another, little thing that just shows that, carbon price uncertainty does have some correlation, say with equity price uncertainty, but, the correlation is not that strong. So you have a moderate correlation with other uncertainty changes. And so this is just again to highlight that it is a conceptually distinct uncertainty measure. You see sometimes, it goes up jointly with other events, This is when it's largely a macro demand side shock. Then uncertainty drives all uncertainty together. But the type of supply side uncertainties that you have, that come from, the regulatory environment, etc., those are sort of uncorrelated with, general uncertainty in the stock market and so on. And then lastly, this is just a graph to show that, the uncertainty we back out from the option prices, which is a forward-looking uncertainty, is actually very good at predicting realized volatility over that horizon, right? So it really shows you, again, this is some sense just a sanity check on the measure, right? When uncertainty is really high, realized volatility over the next 12 months is also really, really high. So this is not just some sort of weird, say, market microstructure type, something weird going on in the pricing, but this is very much a meaningful economic object, and using the option prices does back out something about realized volatility down the road. Okay. We also have a separate measure of carbon price uncertainty that we call the implied volatility. Basically, the way you can do there is you can focus on the most liquid at the money options, but you need a pricing model, right? So you can use, say, the Black-Scholes model or something like that. Through the lens of a pricing model, you can interpret any one option price and back out what uncertainty is. What's going to turn out is that these two measures, this is the left panel here, are like 0.96 correlated. So in some sense, what this tells you is that, the carbon VIX, which is model-free but requires liquidity in out-of-the-money options, isn't driven by extreme illiquidity in terms of prices. If you just take the alternative, you take a pricing model and just take liquid at-the-money options, you basically get the same result. And then the last thing about carbon price uncertainty, this is something that it's interesting and I'm a little puzzled by, is that implied annualized uncertainty over the next 120 days is very similar to implied annualized uncertainty over the next 360 days, which tells you that a lot of it is about stuff that's going to happen over the next few months rather than stuff that's really far out in the future in terms of uncertainty, right? So that's, to some extent, was a little surprising to me. I would have thought maybe, annualized uncertainty for longer horizons is bigger because maybe you get some uncertainty about tech breakthroughs that might happen 2 years from now, but that are probably not going to happen over the next 3 years. But that doesn't really seem to be the case. And so what we're going to do is we're just going to use annualized uncertainty over the next 120 days as our primary measure. But again, if you use the 360, you get almost identical results, both in levels and in changes. Glenn.
Yeah. So that seems like even the 360 in terms of days. I mean, you motivated this sort of in terms of investment, I guess.
Yeah.
Thinking ahead 120 days, I don't know if I'm making, wind turbine power plant investments with the horizon of 20 years. So I guess that's one bit of disconnect I was curious about.
Yeah, I mean, I think that one is really just where, I think what we're looking at largely is the delay and the real options component, right? I think the point, I guess what it is, it's uncertainty, but then the realization might be quite persistent, right? So if over the next 120 days, prices go down by 20 euros, that might be a very persistent shock that then persists going forward. So I think it's a combination of over the next few months, there's actually going to be really meaningful information revealed to me for an investor about what prices for the next X many years are going to be. And so if that goes up, I'm like, I make that decision now. Why not wait 6 months to see if prices are high or low, right? And I think you're exactly right. I mean, you want to make a long-term investment, but in part because prices are relatively persistent, but also because so much about where the long-run price ends up starts getting revealed over the next few months, potentially makes it sort of unattractive to decide right now to do a 20-year investment rather than wait what that shock's going to look like down the road. Now, the problem is if uncertainty keeps being high, it always seems attractive to wait a little bit and see what the next big shock's like. Are we going to be back at 20? Are we going to be 60 a year from now? I mean, who knows? Well, unless that uncertainty comes down, I think this continuing, why make it now? If both, I expect a lot of uncertainty, I expect meaningful information to arrive over the next few months about what that long run price is going to be. That's just going to be really hard to overcome in terms of a decision maker's problem that they're facing, when, in particular, when trying to invest for the very long run.
Great. Sorry, that wasn't quite a clarifying question. I should have
No,
probably
it's great.
held
No,
on.
no, I think these are the types of discussions we should be having. It's a great question. Okay, so that's about carbon price uncertainty. Okay. So how do we look at firm level decarbonization investment? So we're going to try and do two things. The first I'm going to show you, I'm actually less convinced by myself, but I think it feels naturally first. So the first that we're going to try and do is we're going to actually try and measure decarbonization decisions at the firm level. I'm going to show you the data we have. The problem is, like real investment decisions, you don't observe at very high frequency, right? This carbon price measure, because the options continuously trade, we actually observe at very high frequency. But the actual decisions of firms to invest in decarbonization are both hard to observe in general, and even if you can observe them, you can only observe them at relatively low frequencies, right? And so trying to match when I see an investment complete, what was the uncertainty when the decision about that investment was made, is just really, really hard to match temporally. We'll still try and do that because we want to start out by trying to look at something real. What we're afterwards going to do, and I think this is the one I find more convincing, is think about an asset price approach to measuring, expected decarbonization activity. And I'll talk to you about what we do there. But the first thing we're going to look at is we're actually going to try and measure firms' decarbonization decisions, again, at the frequency what we have. So what is the best data source we found here? I mean, it's basically data from CDP, or the Carbon Disclosure Project, which collects voluntary disclosures by about 10,000 firms worldwide. It's really important to point out it's voluntary and it's also not verified. This data is very, very noisy when you look at it. There's a lot of really weird stuff in there. But basically what firms report, it's a huge disclosure, right? So firms disclose large bits of information, their emissions target. And by the way, I think emissions and emissions target data is really clean in here. I think the type of data we want to work with, which is more tricky, is, they also disclose all types of, abatement projects that they've undertaken. And for those type of abatement project, they would report the activity type, the amount invested, a textual description of what the types of things that they wanted to do. And so overall, we find about 2,800 firms report about 12,500 of these types of abatement projects. Again, the problem is that things like the amount invested here, there's clear data entry errors in some of them. Like some firm had a $50 billion investment for a firm that was like, pretty tiny, right? So there's just a bunch of things in there that I'm not going to bore you with what we do to try and like clean up this data, but I think, just to give you a little bit of a sense of why I prefer the asset pricing evidence that I'll show you in a bit, is this. It gives you some sense of, where the investments come from, the number of projects, the number of reporting firms. I actually think this is interesting data per se, because I generally don't think we have other data sets that give you at least some aggregate level what firms do to decarbonize, right? Not just overall investments that they undertake, but investments that they themselves specifically say, we did this to decarbonize, right? So I think it's actually really interesting data. You can see kind of the sectors that undertake, these investments. So you can see, in terms of total investments, like the investments in aviation industry are very big, because it's like, I don't know, we are buying, more fuel efficient engines, or, in utility sector, it's also pretty big investment, because this is largely about like, power plants are just big investments in general. Gives you a little bit of a, yeah.
I have a clarifying question from Richard Toll.
Sure.
Richard. Oh,
sorry, I had to be kicked out and let in again. You have a lot of non-European countries in your data set.
Yes.
Why is that?
You mean the CDP data set?
Yeah.
Oh, because the CDP data set's a global data set. So we have a lot of non-European countries in that. So how do we use that? We're going to use that as it's almost like a diff and diff. So when carbon price uncertainty goes up, do we see a differential change in the investment of firms? So this is this exposure measure. Are you covered by the ETS? And many of the European firms would be. And in fact, like, in the CDP data, they will say we are covered by the ETS or not. But you can either do country of origin or that self-disclosed stuff. And what you have is the non-European countries wouldn't be covered. And so the idea would be, our left-hand side variable, we call the decarbonization investment rate. So it's like, again, this is annual frequency now. So it's much lower frequency than our uncertainty measure. We basically look at total investments in these decarbonization projects divided by scope 1 emissions. That's just one way to, to normalize. Obviously, if you have more emissions, you're going to spend more to decarbonize. And then we're going to regress that on, time fixed effects, the carbon VIX, and then also the carbon VIX interacted with this exposure measure. Richard, this is, I think, your question, where the exposure measure is just, are you covered by the ETS or not? So it is not just in years where uncertainty is high, does everybody invest more? But in years where a carbon price uncertainty is high, do you find a differential decline in investment among those firms that are covered by the ETS versus those that are not? Right? So that's kind of why I think it helps us to have these other firms in the sample, just because I think these other firms give us at least somewhat of a control group. Again, I don't want to overstate, the identification here, but I think that's at least how we use the non-European firms to help us give at least some benchmark of what happened in those years in general. And then we have a bunch of controls. So what do we find? I mean, we do find indeed that in periods where carbon price uncertainty is higher, the ETS exposed firms report lower decarbonization investments per unit of emissions in the CDP data, right? The thing that makes me a little skeptical is that the level of the carbon price doesn't seem to matter as much as the uncertainty in this specific specification. So again, I gave you all the caveats about this data. And in the interest of time, what I want to do is I want to, again, the benefit of this measure is that it's actual spending, right? It's actual activities that the firms do to decarbonize. The downside is it's voluntary, it's not verified, it's not standardized, it's low frequency, and the point of decision is unclear. Okay, so we all, see it's helpful to have this. So what do we do that I find more convincing? So what we do is we look in a high frequency way at the relationship between carbon prices and the carbon VIX and the stock returns of firms that I'm going to call carbon solution providers. So what are carbon solution providers? Carbon solution providers are basically firms whose main business model it is to help other firms decarbonize, right? And the idea here is that if carbon prices go up, polluters' incentives to decarbonize go up, that should increase expected decarbonization spending. And so investors should like those stocks more and should, and the stock returns should be higher. Similarly, if our mechanism is there, higher carbon price uncertainty should reduce polluters' incentives to decarbonize today. It should reduce expected decarbonization spending, at least in the short run. And it should lead to lower stock returns of these carbon solution providers. Okay, so that's the idea. And the beauty of the stock returns is that we observe them at extremely high frequency and it's very clean data. The one downside is that the stock returns are really driven by what investors expecting decarbonization activity to look going forward, and that then immediately gets priced in. And the other thing was actually whether or not decarbonization really behaved in that way. But as someone who sits in a finance group, we generally like to think that stock market investors have pretty reasonable expectations about future spending. And so, that's kind of, and we have some new data now where we show that those stock returns do actually predict the sales of these firms, right? And so to the extent that you think actual revenue of firms that help others decarbonize is a good proxy for actual aggregate decarbonization spending in an economy, I think this is also going to be helpful. So how do we, again, so what are the benefits? High frequency measure captures expected investments. And so what we need to do is we need to actually first identify what are carbon solutions. And then we need to identify firms that provide these carbon solutions to others, right? And so on the what are carbon solutions, we go back to this CDP data. And there it's actually really helpful. And remember, it had this like long textual description of what the project was that a firm does. So here's just an example of a project description, right? So one firm said, our decarbonization investment was the adoption of an innovative carbon capture system at the manufacturing plant to significantly reduce CO2 emissions, right? Or optimization of steam usage by installing advanced steam traps, or installation of geothermal heating and cooling system, or adoption of advanced monitoring technology to detect and repair leaks in our pipelines, right? So these are all the types of projects that I described before. The firm said, what did we do in this year to decarbonize? Well, here's just an example, 5. We got 4,500 of these descriptions, right? And so we're going to use some of these new GPT type tools, natural language processing tools, to classify all of these, thousands of projects into a bunch of categories of what are the types of things that people do. So here's just some example, just a word cloud of sort of the most common types of activities that firms engage in when they say we decarbonized our emissions, right? So it could be methane lake capture, it could be fuel efficiency, wind power, biomass boilers. I mean, there's a long list of things, right? So that gives us a sense of like, what is it that European firms do on average when they say we spend money to decarbonize? And then in the second step, what we do is we try and figure out what are firms that provide these goods and services, right? And so in order to do that, we basically get descriptions from European firms, from every European publicly traded company, and we get descriptions on their activities from Orbis and other sources. And again, we asked GPT, we said, well, you've just identified 2,000 things that firms do that decarbonize. Here is 10,000 firms and their business models. Figure out which of these firms would actually be good at helping others achieve these objectives, right? And so, that identifies about 200 firms that we have, basically able to to manually check all of them. We can't check all the ones that it didn't classify, but all the ones it did classify actually I mean, these tools are pretty neat. So it really does a very good job at like actually capturing firms that do like building insulation, Rockwool AI. I wouldn't have thought of like this company. If you read the name, I mean, many of these are like fairly small companies, right? Wouldn't have thought, but yeah, if you do building insulation, and particularly in the description of your job, of your tasks, you also talk about energy efficient building insulation. Well, you'd be the type of firm whose revenue goes down when carbon price uncertainty stops other firms from investing in decarbonization, right? That's kind of the idea that we have here. We have other measures as well, from that others have produced, but you obviously like our own the most. So then finally, what's the empirical exercise we do? We basically regress stock returns of all firms on indicator of whether the firm's a carbon solution provider, but also interacting that indicator with the carbon mix. So basically the idea is relatively straightforward. The idea is it the case that in periods when carbon prices go up, the stock returns of carbon solution providers disproportionately go up? And is it the case that in periods where carbon price uncertainty goes up, the stock returns of carbon solution providers disproportionately goes down, right? That's kind of the exercise that we have. And moreover, as I mentioned before, we run this exercise over 2 periods. One, when carbon prices were sufficiently high to actually be a relevant object in firms' decision. And one almost like a placebo regression in a sample where they were not. So here's what we find. Left 4 columns is the high carbon price sample. And the first column is our definition of who carbon solution providers are. The remaining columns are these alternative ones that others in the literature have produced. But most importantly, what you find is that it is indeed the case that when carbon prices go up, the stock returns of carbon solution providers disproportionately increase relative to stock returns of other firms, often in the same industry, because we have industry by date fixed effect at the same time in the same country. Okay. And similarly, when carbon price uncertainty goes up, the stock returns decline. And what's really neat about this regression here is that because we now have estimates of both the effect of a carbon price increase and the effect of an uncertainty increase, we can actually put the uncertainty decarbonization disincentives into euro terms. And so what it tells you is that a 1 percentage point increase in the carbon VIX has the same effect on discouraging decarbonization as a 1.12 euro decline in carbon price. So one way to just think about this is if carbon price uncertainty was reduced to the level of stock price uncertainty, that would have the same benefit of boosting decarbonization as a 30 euro increase in the average carbon price, right? So these are really, really big effects of uncertainty once you kind of compare them back to back relative to the the actual carbon price returns, right? So this to me is, I think, kind of where it's not just it discourages, it encourages it in a really meaningful way. And reductions in carbon price uncertainty can have very, very meaningful effects on firms' decisions to decarbonize sooner rather than later, of the same order of magnitude as 15, 20, 25, 30 euro increases in the average carbon price that they have to pay. Okay. Okay, so that's basically the end, and I'm almost at my 50 minutes. So what do we learn? We learned carbon price uncertainty is high. It varies over time, has spikes around natural events, and it reduces decarbonization investments that has aggregate effects. I think what sort of is one takeaway of this from me is, policymakers generally think about their primary lever being the level of the carbon price. But I think to me, a key takeaway here is if policymakers could just get their act together and reduce uncertainty about the price, you could get firms to take a lot more actions. I mean, this is like the more, I sit at a business school, I get to talk to a lot of, CEOs and whatnot. From their perspective, uncertainty is the most corrosive thing to their ability to make decisions, right? Many of them are not that excited that we're now seeing, another teardown of environmental regulation in the US, but they worry, well, 3 years later, it might go up again. Just figure something out. Like, it's fine if it's high, if I know it's high and then I plan and I can actually do stuff. The like constant back and forth between, well, prices might be 80, now they're only 40, now they're 60. That's what makes it so hard for me to do anything, and it's why I basically delay making a decision, right? If you could tell me prices are going to be 70 euros, I can live with that. I can then figure out what investments are sensible ones to make at 70 euros. But if you tell me I can't tell you if it's 50 or 100, well, at that point, I'm not going to make any decisions right now. And so really emphasizing to policymakers the value of providing very clear, almost like forward guidance about where they want carbon prices to be in the future. And maybe even introducing tools like these price ceilings and price floors to say, carbon price, we will not let carbon prices drop below 50 euros a ton. If you know that every investment that reduces your emissions for less than 50 euro a ton becomes profitable with certainty today, and you will see firms engage in those investments. But if policymakers can't commit for prices not to drop below 50, people worry that they're going to make a 20-year investment that's going to be losing the money because next year suddenly, I don't know who wins what election in Europe, and then prices collapse again, and then like this investment's gonna not look so attractive, right? So I think just realizing that somehow finding tools to commit to future prices is a really, really, really important component in order to get firms to make those decisions. As important as the level of the price, I think is kind of, to me, the key takeaway from this overall project. Thank you.